How do mortgage rates work, and how can you avoid the discount point trap? So the first thing we want to talk about is mortgage rates can change multiple times per day. You hear words like the Fed funds rate in the news all the time, and they're changing the rate. Mortgage rates are not tied to that and can change multiple times a day because they are tied to the bond market. And so just like a stock price can go up and down, so do mortgage rates because they follow the bond market. When a lender is pricing out a mortgage rate, what they do is they input the characteristics of the borrower and the loan, and this can be up to 20 inputs that impact the pricing of a mortgage. And so what happens then is a rate sheet is produced for the specific scenario. And this is important to understand that it's not just one rate that is available, but entire spread of rates. And so this is a sample of what a rate sheet might look like. I want to clarify that this is just for educational purposes and by no means represents where rates are currently at this time. And so you'll see in this chart a spread of rates as low as 4%, maybe as high as 8% for this scenario. And there's a rate toward the middle that is called the par interest rate. And so this is the interest rate option with no discount points or no fees attached to it. You have the ability, anybody has the ability to pay an upfront fee in exchange for a lower rate. And so you'll see in this chart that as the interest rates go lower, the fee number in the red goes up. So if this person wanted a 6.75% rate, they would have to pay a 1 discount point fee, which is 1%. In this scenario, that's $3,000. If they wanted the rate option with no fees, it would be 7.125%. And in green, you can actually take a higher than market interest rate and get a credit from the lender. So with this in mind and this new information of how rates work, I want to ask you a rhetorical question. How would you answer the question, what is your rate, if you were a bank and being asked that? Right? It's not as simple as maybe you might think. In all honesty, a lender could tell you any rate they wanted because it's not just one rate that comes up, it's a whole spread of rates. And so this all goes back to the concept of eligibility and suitability. It's important to make sure that the rate you choose is the rate that's most suitable for you and your financial goals. It may make sense to buy down your rate and to have a lower payment, or it might make sense for your situation to have a higher interest rate and get a credit from the lender. So the pro tip from this lesson is you want to make sure that if you are ever being quoted a rate or if you see rates advertised somewhere, the first question you need to ask is, are there any additional fees or discount points associated with this rate? Even yesterday, I'm receiving mail or seeing things online of interest rates advertised that I know are not the market rate because I'm looking at rates every day. And if you look in small letters, you'll see charging 2 discount points or 3 discount points, because in all honesty, in all reality, they are showing an interest rate that is below the market rate and then charging a fee. So it's important to understand how interest rates work to avoid this trap. In the next section, we will be putting all these concepts together in something we call the pre-purchase plan.